An extended pause in the rate hike cycle by the US Federal Reserve on Wednesday night saw most global equity markets lose ground on Thursday. While key Asian indices sank over 1% each, domestic benchmarks nursed losses of 0.8%. With this, the BSE Sensex has tumbled nearly 1,400 points in 2 days, while the Nifty 50 has dropped from over 20,100 levels to below 19,750 levels. Analysts believe that the Fed's forecast of another rate hike by the year end and tighter monetary policy through 2024 than previously expected stirred the hornet's nest, while market watchers remain uncertain if economic conditions would be conducive enough to weather another rate hike. They believe Asian markets are in for a turbulent phase. According to Nomura, equities will likely see some pressure in the very near term as rising US bond yields, stronger US dollar, and elevated energy prices are all bad ingredients for Asia. As regards India, Jyoti Vardhan Jaipuria of Valentis Advisors is penciling in a time-wise and price-wise correction.
Strong dollar per se is always negative for emerging market flows. We always want weaker flows. So to that extent, it would be probably mildly negative for emerging market flows. For most people, India is like the go-to market for the next few years because the consensus believes that India is going to be the fastest growing economy. So to that extent, this may hurt flows a bit, but it's on the margin. In fact, the other thing which is probably hurting flows to India more is just the valuations. Generally valuations are not cheap, and they're not cheap in the India context if you look at history, but they're even more extreme if you start looking at India relative to emerging markets. So that's what we've been hoping, that we get a time and price correction so that valuations become a little better.
The US dollar index is at a multi-month high of 105.5, having risen for 9 straight weeks. This is its longest winning streak in nearly a decade. Yields on the US 2-year and 10-year treasuries are also hovering at their highest level in over a decade, prompting foreign institutional investors to take out more than 13,900 crore rupees from Indian equity markets in September. As the outflows are expected to intensify in the near term, ICICI Securities expect Indian markets to remain volatile. The future trajectory, they believe, will be dependent on how fast the interest rate hikes come to a halt globally and dent the economic growth. As a strategy, ICICI Securities suggests investing in equities in a staggered manner over the next 3 to 6 months, using corrections for making lump sum investments. On September 22nd, interest rate decisions of the UK and Japan will be on the investors' radar amid diplomatic developments between India and Canada.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.